Good morning, everyone. My name is Deewash Bajracharya, and today I'll be presenting my analysis on the financial decision-making process for Summit Trails Go, specifically regarding the launch of a new luxury travel package. Executive summary. To begin, our project involves a luxury Himalayan travel package aimed at high net worth individuals requiring an investment of 6.05 million over 5 years. We will cover key financial metrics including WACC calculation, NPV, and payback period analysis. And also we'll be talking about investment appraisal techniques. Our findings indicate that the project is profitable and worth pursuing. Table of content. Introduction of the company. Summit Trails Co. is a luxury travel company which specializes in guided mountain expedition and personalized adventure travel in the Himalayas. It has extensive experience in the luxury travel industry, and it has built a strong reputation for providing high-end luxury travel plans. Now it has planned on launching an exclusive travel package featuring helicopter tours, premium accommodation, and personalized service to its targeted high net worth customers. WACC. It is a financial indicator which shows the average rate of return that a business must provide to its investors, both debt and equity holders, in order to fund its operation and investment. It is a critical tool for measuring the cost of financing and for making informed decisions about investments, valuation, and overall financial strategy. Cheaper financing is indicated by a lower WACC, and higher capital costs are indicated by a higher WACC. The use of WACC in business can be for investment decisions, evaluation of companies, performance measurement, and risk assessment. WACC and its individual components. Our historical WACC is 18%. Cost of equity came to be 6.67, cost of debt 8.33, market value of debt, and overall the current WACC came to be 7.14. So the new luxury vacation package is more appealing since it lowers the minimal return needed to produce a profit, as seen by the fact that the historical WACC of 18% is higher than the current WACC of 7.14%. The investment is now more likely to generate positive returns. Projected cash flow statement. This is the cash flow statement which I transformed to the bar diagram. So the key points are: the chart shows strong long-term financial returns, proving the continued success of the proposal. Year 1 being slower as a result of initial investment, but gradually improves in year 2. Business performance peaks in year 3 and then slightly declines in year 4. With the biggest cash flow, year 5 has shown profitable growth over time. Calculation of payback period and net present value using the calculated. The payback period came out to be 3 years and 13 days, and discounted payback period is 3 years with 249 days. The NPV value is also very high. The project is expected to be profitable since the net present value is positive, indicating that the returns surpass the cost of capital. Now this is the calculation using it payback period net value using 18% WACC. So discounted payback period came out to be 4 year 236 days, which is much higher compared to the previous one. NPV is also very less. The project will take over 4 years to break even when considering the discounted value of future cash flows. Project evaluation. So the project move ahead. The discounted payback period using calculated WACC is shorter, indicating that the project recovers its initial investment more quickly when the time risks of money is accounted for, and is also more favorable in terms of liquidity and risk. Offers a high return, which almost 5 times greater, indicating a large overall return from the project when future cash flows are discounted, making it a more attractive investment. The project is a better investment based on both the quicker recovery of the initial investment and the higher net returns. For investment appraisal. Net present value. The difference between the present value of cash inflows and the present value of cash outflows over a period. Advantages are: consider the time value of money. NPV fully addresses the timing of the cash flows, the whole of the relevant cash flows, and objective of the business, and also it provides a clear quantitative result. Limitation can be outcome of NPV is highly sensitive to the chosen discount rate. Estimating future cash flows accurately can be very challenging, and it ignores non-financial factors like environmental impact, strategic goals, or brand reputation. Internal rate of return. It is a discount rate that makes the net present value of project equal to zero. Advantage can be used to it is used to evaluate the attractiveness of a project. It makes it simpler for decision makers to understand and compare multiple projects by providing a single percentage that represents the possible return of the project. It is very easy to understand. The limitations of IR is that it is a percentage return, so it doesn't take the scale of the project into account. It is not suitable for comparing projects of different sizes. For long-term projects, the IR may be reliable as it uses a single. It may not be reliable as it uses a single discount rate. Accounting rate of return. It is a financial metric used to evaluate the profitability of an investment or project. Advantage can be used to it can be used to compare different projects as it gives a clear percentage return on investment. It is easy to understand and calculate. It also uses average profits, which is useful for decision makers. Limitation does not consider the time value of money. It may not reflect true profitability, as accounting profits are only taken into consideration. It is not suitable for complex projects. Payback period. The payback period is a financial metric used to evaluate time taken for initial investment to be repaid out of project net cash inflows. Advantage is it is useful for business that prioritize liquidity, easy to understand and calculate as it is straightforward without complex calculation, suitable for quick decision making. Limitation: it does not consider the time value of money. It may not reflect overall profitability, and it is not suitable for comparing projects with different cash flow patterns. Funding options. Equity financing. I have selected equity financing, bank loans, short-term loan, and debt financing. Equity financing. Equity financing, it is the process of raising money through the sale of company shares or ownership stakes. Investors don't expect fixed repayments, instead they receive a return based on business profitability. Advantage: no any kind of loan or interest to pay. Investors may bring expertise and connection suitable for high-risk companies. Disadvantage can be loss of ownership and control. Sharing of profit for investors. Sharing ownership and having to work with others could lead to some tension. The source of this can be angel investors, venture capital, funding from friends and family. Debt financing. It involves borrowing money that must be repaid over time, typically with interest. Advantage can be full ownership and control of the company. Certain interest may be tax deductible, easier planning as payment schedule and amount are paid. Disadvantage: even if business performance declines, payment is necessary. Cash flow may be strained because fixed payments requires collateral and strong financial source. Business loans, bonds and debentures, microfinance, and peer-to-peer lending. Short-term loan. A short-term loan is a loan that must be repaid within a short period, usually less than a year or up to 3 years. It is typically used to cover immediate cash flow needs, working capital, or unexpected expenses. The advantages are faster approval process compared to traditional bank loans, have easy application process, less long-term debt burden. These are higher interest rate, frequent repayments, and limited funding compared to long-term bank loans. Bank loan is a long-term bank loan offered by a financial organization that normally has set payback terms ranging from 3 to 25 years. It is commonly used for funding major projects, buying assets, and expansion. Advantages: interest paid on a business loan is tax deductible. Larger loan amounts, fixed rate loans have interest rates that don't change. Disadvantages: banks require strong collateral and financial records, time-consuming process, and also funds are usually designated for specific purposes and cannot be repurposed easily. This is the bank loan process. Factors bank consider when approving a loan: profitability and project viability. The luxury holiday package financial potentiality is evaluated by banks. The strong profitability is indicated by the project's NPV and at WCC. Payback period is 3 years 13 days, indicating return on investment is met in reasonable time frame. Cash flow. The company must show steady cash flow to guarantee loan repayments. Company's financial health is considered by evaluation debt and equity structure. Collateral availability. Luxury helicopter may act as one, but since it is a depreciating asset, company may need to offer property or business assets to secure the loan. Risk analysis and market structure. As a luxury travel company, Summit Co is risked by economic condition, travel restriction, and market fluctuation. If demand for luxury travel decreases, revenue can be greatly affected. So overall, Summit Co can improve its chance of getting a loan by taking these factors into account and proving that company has solid financial strategy, risk management, and market potential. Protection the bank might seek. Collateral requirement. Bank may require collateral on helicopter along with business assets, property, or company-owned investment as it is depreciating asset. The risks involved in the tourism sector may result in a higher interest rate for the loan. Company must maintain specific financial ratios like minimum cash flow or other conditions specified by the bank. The bank could ask other important directors or stakeholders to provide personal guarantees in order to further protect the loan. Regular financial reporting and audits may be required to monitor the company's ability to meet repayments. Bank may also request for dedicated revenue account in which a portion of the luxury package earnings are immediately put aside for debt repayment before they used for other expenses. To guard against incidents, theft, or damage, the bank might require that the helicopter be completely insured. Conclusion and recommendation. The suggested luxury hotel holiday package seems like a good investment for Summit Trails Co based on the financial analysis mentioned here. Considering the positive NPV and manageable payback period, Summit Trails Co should proceed with the investment but with a strategic approach to funding and risk management. Overall, the project is viable economically, but its success depends on efficient cost control, wise funding decision, and ongoing demand in the market for luxury adventure travel. Thank you. Appendix references.